back to our special show on the Reserve Bank of India monetary policy. We now have with us the country's biggest banker, State Bank of India Chairman, Mr. CS Setty. Thank you very much, Mr. Setty, for joining us. What is your key takeaway from the policy?
Key takeaway essentially is that, I think in my view, the pause is justified. The transmission is work in progress now. The 100 basis point affronting the rate cut last MPC I think it needs to be fully digested by the system. Okay. From that angle, yes, I think it's a very positive
one. The pause is justified. Okay, but the pause is also welcome, I guess, from a banker's point of view. I know that you are tongue-tied now because of the upcoming results. But for the sector as a whole, do you think that Q2 will be the lowest in terms of margins now that chances of a rate cut are not there?
I think the transmission is happening. I think the levels of transmission, as Governor mentioned, is different in the sense that the deposit rate cuts seem to be moving faster for the industry than the loan rate cuts. But this was the trend which we have seen when rates have gone up also. Yeah. The rate cuts on the credit side, essentially, because the whole book is not EBLR.
Yes.
The book, MCLR book also, it takes some time to get repriced. That is a difference which we are seeing, but otherwise, I think transmission is definitely happening.
No, transmission is happening, but would you say that, all banks reported between 5 and 35 basis points of reduction in margins in the earnings season that's underway. Do you think we will see more cuts in the current quarter? That is the July, August, September quarter. But that will be the worst. You will start seeing improvement in margins from Q3 for the sector.
There will be some calibration on the MCLR side because, as I mentioned, there's a lag. Some of the rate cuts which are affected in deposits the last month are, that get impacted in the current month, which means that in this quarter also you may see some readjustment of MCLR by many banks.
Okay. But you expect margins can improve by the next quarter?
Yeah, I think I did mention Latha last time also that the NIM trajectory would be U-shaped and most of the NIMs probably will come back to the normal level at the end of the financial year.
By the end of the financial year. Okay, I wanted to move. The worry is more about credit growth, actually. For the system, it is in still single digits, not yet reached 10%. Do you think that, are you seeing enough impulses in terms of a double-digit credit growth for the system? Not for SBS, sir, for the system.
For the system, generally, Q1 is a lighter quarter. But the base impact, the last year, the 24-25 credit growth was robust. That's the reason I think the percentages looks lower. But generally, I think we all are expecting that the Q2 may have some positive impact, but not very noticeable one.
Okay.
And the second half, Q3 and Q4, generally are good quarters. And hopefully, I think the system will have a better credit growth going forward.
Okay. I'll tell you, the big borrower, that is corporates, are now actually seriously deleveraged. And it's not as if we've got too many capex plans. If you look at the CMI numbers, it's more a government capex, private capex is not roaring. As well, they have enough money, internal retained profit. The retail sector as well, you don't go and buy a house simply because rates are cheaper. The way in which TCS announces job cuts, the confidence channel is not really shining bright. So do you think that in spite of the fall in cost of money, the extent of loans may not grow very fast?
Housing is a different ball game altogether. I think a lot of investment decisions are made, obviously, taking several factors into account. One is, as you mentioned, of course, the confidence of continuing in the job is a very important one. But the large unmet demand for housing is always there. So that has resulted, even if you see, while it is rate sensitive sector, mortgages, always, long-term mortgages, people do upfront their investment decision if the interest rates are lower. But they also know that it depends on the affordability and the need for housing, and all these things come into picture. Last time around, when the rates were higher, even then we have seen a robust housing loan credit growth, which means that the housing loan market, I mean, seem to be decoupling from the interest rates.
That's my point, sir. If housing loan is not taking cues from the rate cut and corporates are not taking cues from the rate cut, necessarily will rate cut mean a very good credit growth?
Let me finish on the housing and then I'll...
Sorry.
So I think what I'm trying to say that while last time around, even higher rates of interest propelled people to buy houses, the need for housing is definitely there. And coupled by the fact that interest rates are softening, it would definitely improve the housing loan growth rate. And as Governor mentioned in the presser, 14% industry average growth rate is not a small one in housing. I think it's a very robust and it's a very large base of housing loan segment now. So 14%, I believe, is a very good growth rate. We need not really worry about housing. And the corporate, yes, I think there are several factors influencing corporate credit, particularly in terms of the movement from the bank credit to the markets. Obviously has happened. Not necessarily that the CP/NCD market, the participants are banks. In fact, I feel that less participation with the bank in CP/NCD because the rates are historically low now. It's mutual funds, insurance companies which are participating, which I believe we should all welcome, right? When the households are moving there, they should participate in the debt market. I think we should not really worry about it. What we need to really be concerned is that the private capital investment is not broad-based. We are seeing that it is primarily coming from the renewables, roads, or maybe some data centers. We still are able to see what is happening on the core sectors. Cement and all. I think it's industry-wide. The combination of not taking the investment decisions at this moment, and also the fact that they all are having adequate cash balances. So that is also is one of the reasons why we don't see corporate credit happening as much.
Okay, so we will continue this conversation when your results come out and you are in a more cool position to speak about the future. Thank you very much indeed for joining us. That's the State Bank of India chairman. From a banker's point of view, the margin cuts perhaps end with this quarter, and you may see improvement in margins from Q3 onwards, and definitely improvement in Q4 because further rate cuts are not there. But on credit growth, there are still some question marks. And on growth itself, if the global confidence and the global uncertainty doesn't change. With that, we wrap up on this show. Thank you very much for watching.